Hello, everyone. Dave Landry here from DaveLandry.com. Welcome to Trading Full Circle. This is Section 1, Building the Base, Part 1, Why Trade and Why a Proper Mindset is Key. Before we get into all that, first of all, I'd like to thank you for taking time out of your busy schedule to watch this course. So what are we going to talk about? Well, first of all, let's talk about why you should trade, the difference between a stock and a company, and those are two big differences, as you'll see in just a few minutes. The reasons why people buy and sell stocks, and that might not be what you think. The importance of developing a proper mentality towards the market. Above all, regardless of the methodology or your money management, the mentality, as you'll see, is key. And then I'm going to touch upon the fact of how and why technical analysis leads the way, and why technical analysis, in other words, the use of charts, is the only way to trade. When I began working on this course, I thought, okay, this shouldn't take too long. I just need to cover the basics and let you know what you need to know, assuming that you didn't know anything about trading. But quickly it became something much bigger than that. Not only the basics, but what would someone who was much more experienced need to know if they began struggling in their trading? And along those lines, putting myself back in the shoes of that younger punk version of me, what would he want to know 20-something years ago when he was just getting started out? What would he need to know about trading? And then it became something much bigger than that. So this leads us to a quote from John Bollinger. John Bollinger used to have a forum for his peers, and he was kind enough to ask me to join, and I was honored to be a member of this professional traders forum. And John would often end his post with the byline, "If you advance far enough, you arrive at the beginning." And that made a lot of sense to me. And I used it quite often in my webinars and presentations. And I asked John, I'm like, John, what's the genesis of this quote? And he said he was probably inspired to say that based on a book about Albert Eiler, where they said that he advanced so far he came back in at the beginning. And he said it's probably originally expressed, or that thought I should say is originally expressed in the T.S. Eliot Four Quartets quote, "We shall not cease from exploration, and at the end of all our exploring will be to arrive where we started and know the place for the first time." You guys that are married probably know what I mean by saying that your wife could often be brutally honest. And a few months ago, my wife Marcy came into my office and said, "Hey, what are you working on?" I said, "Well, I've been working on this beginner's course." And she's like, "You still working on that?" I'm like, "Yeah." She goes, "Well, what do you have? Let's see it." So I showed her these first few slides and the Bollinger quote and T.S. Eliot and all this stuff. And she says, "I don't get it." And I'm like, "Well, what do you mean you don't get it?" She says, "Well, as a beginner, this makes no sense to me." And I thought long and hard about it. It's like, well, maybe I need to take that out. And then it's like, no, it needs to stay in there because eventually you will. And in the meantime, I found this quote from Curtis Faith, which makes a lot of sense. It takes a lot of time and study before one realizes just how simple trading is. But it takes many years of failure before most traders come to grips with how hard it can be to keep those things simple and not lose sight of the basics. And that's my feeling with this course. And you're going to be surprised as you become more and more educated in your trading that you'll come back and see that 90, maybe even 95% of everything you really need to know in trading is right here in this beginner's course. So that's where I'm going with that. If it doesn't make sense to you right now, I can promise you it will. Now, when it comes to trading, what's more important, attitude or aptitude? And the answer to that is attitude. In fact, once we get further into trading psychology, you'll see that the smarter you are, the harder it could actually be. I would much rather have someone with a really good attitude versus someone who's incredibly intelligent. The way you approach the markets, your mentality is key. And I found this definition from vocabulary.com that I like a lot. It says a habitual or characteristic mental attitude that determines how you will interpret and respond to situations. Now, before we get much further, I guess we need to take a look at the disclaimer screen. As you know, you can lose money trading. And quite frankly, I can sum it up much easier by saying all predictions are about the future, and a lot of stuff can happen between now and then. Now, let's talk about why you should trade in the first place. And the reason you should trade is because markets go up and markets go down. Now, I know that's a bit of a Captain Obvious statement, but let's take a look at that. If you go back and look at the last 20-something years of the S&P 500, you'll see that obviously in the early 90s, we had this tremendous bull market, but then we had a really bad bear market, and the statistics on that are pretty ugly. We had another bull leg higher, and then we had another really ugly bear market, and then followed by another up leg. And then over the past few years, we've had 2 or 3 years of mostly sideways action up until very recently in early 2000, late 2016, early 2017, where the market began to take off again. So the most important thing to glean from this is that the market doesn't always go up longer term. So 50% or more losses are not uncommon. And if you lose half or more of your money, that can be quite destabilizing to you. And this is especially true if you're nearing retirement. Let's take a look at this. From 1929 to 1959, peak to trough, the Dow Jones Industrial Average lost 90% of its value. It took it nearly 25 years just to get back to break even. So let's take a look at that. So you can see in 1929, obviously we had the Great Depression and the market sold off especially hard. But what's interesting is it took 25 years, over 25 years, I should say, just to get back to break even. As I've written before at cocktail parties, sometimes I'll say, hey, you know, the market can go 25 years without going higher. And people will look at me like I pooed my pants. And it's like, it's true, but most people don't believe that. So let's take a look at some other periods throughout history. In 1966 to 1983, the market lost 40% of its value in 8 years. And there was virtually no return for 17 years. So you might be thinking, okay, well, that was then, what about now? Well, as we just saw, we had some pretty bad bear markets in more recent times. But to put that in perspective, in 2000, the S&P 500 and the NASDAQ lost 43% and over 75% respectively. The 2007 bear market, the S&P dropped over 50%. And then, as I mentioned a few minutes ago, over the last several years, up until very recently, the market hasn't made a whole lot of forward progress. So you may be wondering, why is there this lie about the fact that the market always goes up longer term? Well, my way to wrap my head around that is that it's much easier to be a salesman than a market timer. I'm friends with a trader, and when he started out as a broker, thinking that that would get him into the trading business. And then, as he often says in webinars, he was just an asset gatherer. He wasn't an actual trader. And that's why he decided to get out of that business and get more into the pure trading business. So, again, it's easier to be a salesman than a market timer, but there is some truth in all this. And that makes me think about the phrase lies, damn lies, and statistics. So if you look at these buy and hold metrics, they're based on an 81-year time horizon. And this is from Greg Morris in his book, Investing with the Trend. So when you think about that, 81 years, most people don't have that long to invest. If you think about it, you got out of college, you get your job, and if things progress as they do for many people, you end up getting married, you get a home, have kids, cars, mortgage, etc. So you really don't have a lot of time and a lot of money to start investing. So it's not until you get a little older in life, then you begin to get serious about investing. So as Sweet Brown says, 81 years, ain't nobody got time for that. So I think it's safe to say that markets go up and markets go down. Now, if a market is going up, you want to be buying stocks. If a market is going down, you want to be selling stocks. And if you're a little bit more advanced, you might actually even want to short stocks. In other words, look to seek to profit as the market drops. Now, we're going to get back to trends in a lot more detail in future presentations. Now, before we go any further, just realize that trading is trading. Our focus here is going to be mostly on stocks. But I believe that a market is a market, and I do trade markets other than stocks. I just prefer trading stocks because they tend to make larger moves over a shorter period of time. In other words, they're a little bit more inefficient than other markets, and I'll explain that further in the presentation. And by the way, I will use the term stock and market interchangeably because I do think that markets are markets. Markets are based on human behavior, as we'll see here in a few minutes. And that's regardless whether it's a stock or commodity, Forex, or any other trading markets. So let's talk about what a stock is. A stock is a piece of paper that represents ownership in a company. Now, a company or a business is a person, partnership, or corporation engaged in commerce, manufacturing, or a service. It is a profit-seeking enterprise or concern. Now, when you think of a company versus a stock, one is a physical entity and one represents ownership in the physical entity. So this is what a share of stock looks like. And as you can see, it's very beautiful. In fact, I actually use them as decoration in my office. I have a wall with just stock certificates. And if you're interested, you could actually buy them really cheap on eBay, provided that they're canceled. They'll have holes in them or they'll have a stamp on them that says canceled. Once they're canceled, they're not worth anything other than the paper they're printed on, unless, of course, it's some sort of rare stock that's hard to find. But most of these you can get very cheaply, and it's a great way to decorate your office. And they're just really beautiful. Now, let's talk about what a company is. This is what a company looks like. When you think of a big company, you might think of a company that looks like this. This is the world headquarters for Big Dave Trading. Actually, it's the VW headquarters in Stuttgart, Germany. Now, for something more intangible like insurance or maybe a financial product, you might visualize the company as looking something like this. From those of you from Chicago might recognize that as the John Hancock Center. One thing very important to remember is that a stock is not a company, and conversely, a company is not a stock. Now, this might seem fairly obvious, but many people confuse the two. You might believe in a company and think the company is going great places and going to do great things, and maybe they will. But that's not a valid reason to buy a stock. So why should you buy a stock? I'll often give presentations and I ask this question, and I get quite a few answers. But there's only one real answer as to why you should buy a stock. And that only answer, and the only reason is to make money. So why do people sell stocks? Well, people sell stocks for a variety of reasons. They might be getting divorced, they might be getting married and need some money for the wedding, or there might be a death in the family and they have to settle the estate by selling the assets. Kids could be of college age and they need the money to pay for their tuition, or they might be buying a house, and the list goes on. And the point is, did you notice anything here? Well, none of these reasons have anything to do with the underlying company. Now, this line of reasoning comes from Dick Fruth, Fruth Capital Management. I'm good friends with Dick. We met at the American Association's, or I should say we met at one of the American Association Professional Technical Analyst meetings a few years back, and we've become good friends. And he's often tells a story of when he got his first job as a broker many, many, many years ago. Back then, people didn't trust the brokerages to actually hold their shares, so they kept them in a safe deposit box, or they kept them in their safes at home, and then it actually would bring them in and turn in their shares. Now, Dick says that the old curmudgeons, as he calls them in the office, would snatch the shares out of their hands and shove them a ticket or a check, whatever the case may be. Dick's a little bit more gregarious than that. Dick would sit them down and get to talking with them and chat them up a little bit and find out why they were selling the stocks. And he became fascinated that the reasonings rarely had anything to do with the underlying company. Now, when you buy a stock, you're forming a relationship between you and the company. And as a general statement, that company does